Hello, everyone, and welcome to the latest episode of What to Think, VentureBeat's technology news podcast. Today's episode is part of our Innovation Engines series, sponsored by Pivotal Tracker, and today's guest is Redpoint Capital partner Tomasz Tunguz. But first, VentureBeat reporter Ruth Reeder and I are going to talk about the week's news. How's it going, Ruth?
It's going pretty well. How are you doing, Dylan?
I'm well, thanks. Haven't had you on the podcast in a while.
I know.
So it's good to have you back, and it's good to be back in general doing the podcast thing. Let's talk first about Apple news, because, you know, everyone loves to hear about Apple news.
Everyone loves it.
As we record this, it is not yet on sale, but this week the iPad Pro will be going on sale in more than 40 markets. Now, this is the gigantic 12-inch screen iPad that comes with a $100 pencil and a $150 or $160 keyboard if you want to use it as a laptop. Tim Cook has been going around saying, I just travel with this. I don't need a laptop anymore. So, I don't know. Are you going to get one, Ruth?
Oh, you know, honestly, I kind of do want one. Oh, it's terrible, but it's true. I mean, it does look really cool. And I actually haven't had a device with a stylus before. Uh-huh. And I feel like this might be the one to get. I think the most interesting thing about Apple's iPad Pro is that it is exactly like the Microsoft Surface.
It's so much so. I mean, I'm using a Surface and I'm like, I would love to get an iPad Pro, but I kind of already have one.
Yeah, why would you get it? But it's really interesting to watch Apple, who is like the innovator of all innovators, follow on the heels of something that Microsoft has already done.
Well, if Apple knows one thing, and it's known it for a long time, it's how to identify another good idea and adapt it to its own purposes. Going all the way back to the GUI, right?
Yeah, exactly.
I think that this is a recognition that Microsoft really was onto something. I will say I've had some disappointments with the execution on the Surface. I think Windows is not fully adapted to a tablet interface yet. On the other hand, it's Windows, right? So I can run any Windows software, and I still use Office and PowerPoint and things. The question is, for the iPad Pro, really, I think, is whether Apple can adapt it fully to that laptop style of use with a keyboard and, you know, the kinds of things people expect to do with the laptop.
Well, I think that's part of it. And also, I think, you know, Microsoft has made such a play for the enterprise space in general. So as you were saying, like, it has all these great apps for the office. Yeah. Whereas Apple has much more made a play for sort of like the creative workplace. Right. So I think a lot of its success will really depend on how well it can really provide for, like, for example, the Adobe suite and being able to like do that collaborative work and like use the stylus. And if it can sort of fill that space and really provide a service there, then I think it will do well. But, you know, Apple is so much better at that intuitive product than Microsoft is.
I think so. I mean, they're just better at taking care of the little details. You know, my experience with Windows has been that it's pretty good. They've got all the features there, but it's like in some cases it feels like they just didn't quite finish the design process. You know, icons that aren't quite finished, or some things are a little smaller, like they're meant for a mouse-driven interface and they don't expand in the touch-driven interface. It's just like Apple does not let that happen. Apple thinks through virtually everything. So the overall experience is a lot more seamless, I think. It's a recognition, I think, that people already use iPads for creating things, and if you're doing that, you probably want a bigger screen.
Absolutely. Especially as it makes more of a play for the workplace. Like, that's what you need. If you're collaborating on projects together, creative projects, like you need that space to work on.
Yeah. And I will say the lovely thing about the sort of tablet mode with a very thin keyboard cover is that traveling with it is super light. It adds very little to my shoulder bag.
It's really true. You know, for a while, I would go to press briefings with an iPad and a Bluetooth Apple keyboard. And it was like the funniest thing because, you know, you can't really set it up.
You've got like two pieces, yeah.
So it would look like I was typing on this phantom computer. But the reason I did it was because it's just so much lighter. And it'll be nice to be able to do that officially with an Apple product.
Let's talk about Facebook next. What's the big news with Facebook, Ruth?
So the big news with Facebook is that it started trading at a value worth $306 billion.
Last week,
Sorry, yes. and it lowered a bit to 292 billion. Really what that was a check-in on like, where is Facebook as a company financially, especially as it's compared to some of the other big giants, and like, who is it up against?
It's well over 300 billion now, but
yeah,
I thought that Harrison Weber on the VentureBeat news team did a really good job of putting it in context, just with a chart. We'll include a link on the podcast post, but a chart showing how much Facebook is worth compared to all these other companies.
Well, that's the whole thing. And it's like, it's right up there with Amazon. It's creeping up on Microsoft. It's still, like 130 billion behind, but like we're seeing it. We're seeing that growth. Mm-hmm. And that's really impressive. Definitely
worth more than GE, IBM, any of these stalwarts of the mainstream economy. But the company has definitely demonstrated that it knows how to make money, particularly from mobile. That's pretty powerful.
Especially because we're also watching it, Facebook has always been about ads, right? But now we're watching it expand into like buy buttons and e-commerce and other sort of like monetization streams. So yeah, and I think that this just shows that, like you said, they're totally capable of making money, and they're only going to continue to do so more.
Yeah. In a survey of top publishers, they found that during 2015, their traffic from Facebook, the clicks, the people that Facebook is sending to these publishers, has dropped 32% over the course of the year. It's not really clear why. A lot of people are thinking that, it might be a combination of factors. One is that, Facebook now lets you publish directly on its platform through these instant articles. Another might be that they're just trimming back on organic referrals in hopes that publishers, like everybody else, will just start paying Facebook in order to get people to come to their sites. It's a sign of the platform's power, I think. I mean, that's why it's worth $300 billion, because it controls so much, and even controls, how we access media now, which is of interest to me and you, at least.
The traffic thing is really interesting, actually, because it's not just publishers that are sort of seeing that job. I think it's like anybody who's posting sort of natively. I know that I've heard, this is like rumory, but like there are advertisers who have stopped sort of using their Facebook pages because it's just not driving the traffic it once was.
Yeah.
And I think that's really interesting. But I also think that's a play for Facebook, because then they can sort of be like, that's right. You can't just post for free anymore.
The free ride's over.
And that's probably an indication of what that 30% drop is.
Yeah. Now let's talk about BlackBerry. Here's a company that is definitely not worth $300 billion.
Poor BlackBerry.
I know. Feel sorry for those Canadians up there. They just came out with a new phone, the Blackberry Prive, which is their first entirely Android-based phone. They had some phones before that could run Android apps, but were still running on BlackBerry OS. But it has a keyboard.
They've always had this robust keyboard, so it's funny to watch them come out with this touch phone that is so, in line with everything else that's on the market, but then also, of course, has the signature keyboard, which a lot of mobile makers have abandoned.
It's sort of a stealth slider. I was really amused to read in Emil's review that he would hand his friends the phone and say, hey, what do you think of this? And they'd check it out and they'd be like, oh, it's pretty decent. And then he'd go, but watch, zip, slide out the keyboard. And they'd be like, whoa, that's incredibly cool. Phones with keyboards seem so old-fashioned now. But they're fundamentally pretty practical things, little keyboards, aren't they?
Yeah, I think they're totally practical. And honestly, for a lot of people, they're preferential. Like, there are plenty of people who, during the move to, touch screens, were sort of like, my thumbs are too big to deal with.
Exactly.
Keys, not real keys with digital keys. So I think that there are definitely going to be people who are interested in BlackBerry's keyboard. But the Prive is also a really interesting move for BlackBerry because they've seen such a decline in mobile phone sales. Mm-hmm. So this is really, in a lot of ways, like a final attempt at like making it in the market.
I have to say, though, given the price point for this phone, which is $700, and those are US dollars, not those crazy Canadian dollars, I think it's a lot to pay for what is essentially just an Android phone with a keyboard.
It is an Android phone with a keyboard, but then, you have to understand that BlackBerry's big play is around like enterprise security.
Yes.
So like you're buying a secure phone, and more often than not, they're angling to have employers buy this for their employees. Like, I used to work in the government, and everybody in government had a BlackBerry phone, and that persisted even until recently. So I think they're going to be looking for big contract deals where they're going to be rolling out these phones, not to like average consumers as much as they are to like businesses.
That makes sense. And if they succeed in hitting that market, that might be just enough to keep the company alive a bit longer.
It could. Otherwise, I guess they'll just, focus on providing enterprise security for mobile.
Yeah, which is much less boring. Well, yes, I actually fully useful and needed enterprise security, especially on mobile. But it is less exciting than seeing, a new phone come out every few months.
Oh, of course. I mean, and then they won't be on that cycle, that like media churn cycle of new phones.
Exactly right. Well, that's all the time that we have for news. We're going to go to our guest, Tomasz Tunguz, in a minute. But first, I want to take a second to thank our sponsor, Pivotal Tracker. It's an agile tool that's been organizing software teams since 2006. Tracker's simple drag-and-drop interface and structured workflow have allowed developers, product managers, and designers alike to build and manage better software one story at a time. And you can check it out by going to pivotaltracker.com to sign up for your 30-day free trial and start delivering better software now. I've got Tomasz Tunguz, who goes also by Tom. Welcome to the podcast, Tom.
Thank you very much for having me, Dylan.
You're a venture capitalist at Redpoint, but before this you were at Google, and why don't you tell me kind of how you got here?
Well, when I was 17, my dad sent me to South America, and I got an internship at a law firm. And that internship started a little software company that my father and I worked on for a little while. And that's when I first got the software bug.
You became a programmer.
Yeah, he and I worked on it together, yeah. Okay. And basically the general partner of the law firm said, hey, we're 4 months behind on our bills. Can you build an Excel macro, is what he said. And one thing led to another, and so my dad and I worked on this little software company where we were building time management systems and invoicing systems for law firms. I went to Dartmouth, I studied computer science and mechanical engineering. We managed that business for about 3 or 4 years, and then when I graduated, I really wanted to learn what it was like to build a software company for real. Not just a little shop that we had, but how do you write software professionally, and then how do you deploy it? And so then I went to work for a SaaS company in Washington, D.C. of all places called Appian, which wasn't venture back then, but is venture back now. I worked there for about 10 months as a Java engineer, and so I learned what it was like. We had clients like the U.S. Army and the U.S. Navy and Homeland Security. So they were serious customers with serious security clearances and documentation guidelines and that kind of stuff.
Kind of a big deal, yeah.
Yeah, so I learned I learned what I needed to learn, and then I went to work for Google for about 10 months, and I started in the AdSense operations team there, which is a customer success team, a customer expansion team for AdSense. And I was there for about 14 months, and then I switched to the APM program that Marissa Meyer managed.
Okay.
And so I was there for about 2 years, and I managed a handful of teams, and we were doing both internationalization of AdSense, so launching it in new languages, and then also a series of products, advertising products for social networks.
Okay.
And so I was there for about 2 years in addition, so 3 in all, and then I came to Redpoint about 7.5 years ago.
And you've been at Redpoint ever since?
Ever since, yeah.
So it's sort of unusual for somebody to make the jump from software or from engineering to venture capital so earlier in their career. What prompted that?
I had a wonderful time at Google, but at the time when I made the move, I was looking for new projects. And venture capital has this kind of this mythical aura around it, I think. And,
especially in this part of the world.
Yeah, and I didn't grow up in this part of the world, so I hadn't really been exposed to many VCs. But I met one VC at a party, and we just kind of started talking, and I fell in love with the business like a lot of people do. I talked to a bunch of different firms, and then I met a recruiter, and then he introduced me to the Redpoint guys, and we started having conversations. We started going to dinner, and one thing worked out, and one thing led to another, and it turned out to be a really great fit.
Okay.
I love the Redpoint culture. I think that was the main reason I joined. The other main reason is Redpoint has a strong history of promoting young guys to senior guys, and so when I joined, all but one of the partners had actually started as associates and then eventually became partners.
That's very unusual in venture firms.
Yeah, and venture capital is an apprenticeship business, so there's also a strong culture of mentorship at Redpoint, so having that history was really important to me. For any young venture capitalist, having that kind of mentorship is critical for their success.
It's been great for you, right? It's been 7 years.
Yeah, I've been very lucky. It's a privilege to work at Redpoint.
One of the things that I think kind of sets you apart, I mean, you're a blogger, obviously, but many VCs are bloggers. This is maybe 2 things, but you post almost every day.
Yeah.
For one.
Every working day, yeah.
Yeah, exactly. And then Not only that, but you bring a really analytical approach to what you do as a blogger. Like you're really like
Thank you.
diving into data sets and slicing and dicing and creating interesting graphs. You're not just regurgitating things and you're not just bloviating. Like you're actually providing some analysis. That's cool.
Thank you.
I have to ask, because I'm a blogger, I've been writing for years. How do you do that every day? Like come up with those insights?
Yeah, so I started writing maybe 4 or 5 years ago. And I just started waking up really early. I was a rower in college, so I was used to getting up early. You know, I started writing, and in order to have that kind of discipline, I think you need to build it into your daily life, right? Like, and what I learned with Crew was if you wanted to get something done, you made sure you did it in the morning before anything else. Mm-hmm. We have 2 sons at home, and when Henry was born, our older son, you know, he was getting up at like 4:30 to have some milk, and so it just kind of, you know, one thing led to another, and so I just kind of continued that pattern. Yeah.
Okay, so you would get up with your son, and
give him a bottle, and then I would write.
Nice.
Yeah.
Okay. So a lot of the work that you've done has involved analyzing data about SaaS firms, which is your focus, right?
Yeah.
And the data you're getting is from public filings when they have IPOs, correct?
Yeah, that's part of it, yeah.
Okay, so tell me about how you found this data and what you do with it.
Yeah, so I use Crunchbase, really useful data set, Capital IQ, which is a service that we pay for. Mm-hmm. I actually spent a fair amount of time creating our own data sets. So like one post I did was on when do startups hire VPs of sales, right? There's no data set, so I just went on LinkedIn, you know, kind of compared the founding date, found the first VP of sales, and you just do the subtraction and the dates.
Okay, and you script that presumably?
No, that one I did by hand. That one's really hard to script because it's really, I mean, how do you search in LinkedIn for the first VP of sales at a company, right?
Fair point.
So you just limit the number of companies and you can get to an N of like 30. So you get somewhere close to significance. But yeah, that's kind of how it works. And, you know, I started doing the data stuff because one of my partners, Jeff Yang, was taking me to a bunch of different board meetings as part of my mentorship and kind of apprenticeship process. And entrepreneurs would have these questions and I had no idea what the answers were. I was curious myself. And so I just did the analysis and I'd share it with one entrepreneur, but then I figured, hey, I might as well syndicate this because I bet there are a bunch of entrepreneurs who also have this question.
Right.
And so that's how it all kind of got started.
How widely read is it now?
It's like 100,000 views on the domain a month. And then something similar on LinkedIn, 10,000 email subs, 10,000 RSS subs.
One of the things I like about it is so direct and, you know, it provides, if not advice, at least really concrete data points, like, you know, when do I hire a VP of sales, right? Or what's the right, you know, way to compensate my sales force in a SaaS company, or at what point do I need to start, you know, putting in more layers of management, right?
Yeah, that was a fun post. I just really wanted to be tactical. And my perception is it's hard for entrepreneurs when they read about advice is advice works really well in a particular context at a really particular point in time in a company's evolution, right? Like you can't use the same piece of advice when you're a seed stage company as when you're a Series D company, right? Or 7 people versus 700 people. And so what I really try to do is just kind of show the continuum, where a company is in its progression, and as you know, as a result of that, what kind of advice makes sense. Yeah. That's always in the back of my mind.
Okay, so tell me about your focus on SaaS companies. How did that come about?
Yeah, so I actually started in consumer at Redpoint, believe it or not. And my first investment at Redpoint is, I worked on it with my partner Tim Haley, and it's ThreadUp, which is I think it's the largest secondhand clothing store online now. And it's growing really quickly. And what I loved about that business, and what I learned about e-commerce businesses or Adam's businesses, is that they're incredibly metrics driven. And that's because the gross margins and the margins generally, or at least compared to software, are smaller, so the margin for error is smaller, so you have to be far more disciplined. But what I really liked about it was the fact that that business could be analyzed.
Throwing off a lot of data, right?
A huge amount of data,
turnover and
exactly, And so I just love that part of the business, right? Because it basically means that you have this money-making machine and you have all these different levers that you can pull and all these different analyses that you can do. And so I was really drawn to that. Part of it's my background, I love statistics, and at Google we did a lot of numerical analysis on the ads platforms and that kind of stuff. You know, and then I came across software companies, and they're also incredibly quantitative businesses. You can measure them, you can benchmark them, they often look very similar to another. I mean, you look at consumer companies, there's a huge amount of variance. I mean, between a Snapchat and a ThreadUp or a Netflix or an eBay, those are all very different business models, right? Some are subscriptions, some are transactional, some are marketplaces.
Very hard to make meaningful comparisons or draw generalizable insights across those.
The sample size is smaller, you can still do it. And I didn't really realize this at the time, but what's great is there are so many SaaS businesses, right? So it turns out that enterprise investment is 60 to 65% of all venture dollars. right? Like, consumer gets all the press, but it's about 15% of dollars invested by VCs. And so the universe of companies that you can invest in is much larger, and consequently the universe of companies that you can analyze is much larger. I was really drawn to that, and then when I reflected on the products that I had worked on or built, they were all workflow tools. It was initially a workflow legal software tool, and then it was a bunch of workflow tools inside the Department of Homeland Security, and then at Google is AdSense, which is an advertising or publishing workflow tool, basically. And so I knew those products the best, and so there was a nice match there, right, of products that, a little bit of product experience that I had, and then also the natural quantitative characteristics of those businesses.
So tell me about the SaaS market. Like, it's been around for a while now, right? And as you point out, there are many companies in enterprise, most of which have adopted a SaaS model by now. Is the market mature enough that it's predictable? I mean, can you look at companies now and say this is a winner, they're doing everything right? Is there a playbook? Is there still like a certain uncategorizable X factor?
There's always going to be an X factor because SaaS companies are always going to find new models, right? That being said, just looking at the financial metrics of a business, you can tell which ones are going to be the exceptional ones. So sales efficiency, for example, how much it costs to acquire a customer, how quickly you pay back a customer. Most SaaS companies are now measuring themselves according to those benchmarks.
Sales efficiency, time to
pay back
the cost of acquiring a customer.
Yeah, exactly.
And then churn.
Churn, quota attainment. I mean, there are probably like 25 or 30 first and second level metrics that SaaS companies are going to analyze themselves based on. And if I had to invest in a company, if you gave me 20 companies and just the metrics, I think I could pick the one that was going to be a winner, even at a 10 person in size.
So that early, like, those metrics start to be predictive.
Yeah.
That's really interesting.
You can see whether or not the engine is working. And then the other one's like account expansion. Like, if customers really love the product, then they're just going to keep buying more of it, particularly if it's priced that way. There are definitely certain benchmarks, and there are benchmarks that we look for when we invest at different stages of companies. But like I said before, every once in a while, and this is the companies that we race to invest in, there are exceptional models. I mean, companies that suddenly discover a new customer acquisition mechanism, or are addressing a market that's never been touched by software before, or have some other go-to-market innovation. Like we had Kenny Van Zandt at Redpoint last night, and we were talking about flywheel business models, like Asana, where he works, or Expensify, that we're investors in. Those are flywheel business models. And like Atlassian, which will go public soon, is also a flywheel model. And that's a completely different go-to-market than kind of a traditional top-down sales model, even in SaaS, right? So Salesforce would be a good example of that.
Explain the flywheel model, because I'm not sure our listeners will know that.
Kenny explained this really well. He said, most people don't understand what a flywheel first. So let's first describe a flywheel, and then we can describe the analogy. So flywheel is a wheel that's used in an engine to store energy. And what ends up happening in like tractors or other farm equipment is the engine doesn't actually provide consistent power output. So the engine does a bunch of work, but also spins up this wheel, which weighs a lot. And it spins it up so that whenever the engine output varies, it decreases, there's some energy that comes from the flywheel in order to make sure that the output is consistent. Yeah. And the way that Kenny described it last night, which was really great, before he was at Asana and before he was at SolarWinds, which were two flywheel companies, he worked at a telecommunications software manufacturer that he took to about 100 million in bookings. It was a hugely successful business. But he'll tell you that every quarter you start from zero, and in order to hit the number, there's just a huge amount of effort that the go-to-market team has to put in, right?
That is not a flywheel business.
That is not a flywheel business. Yeah, and so you start from zero every quarter, and in order to make it, everyone has got to race like crazy in order to close the business. Contrast that with a business like Asana or Expensify. If there's no one working at the office, the company is still attracting users, converting users to paid, upgrading them. That's the flywheel component, right? So Monday through Friday, 9 to 5, or whatever hours the startup works, the engine is working. The go-to-market engine of the company is working. And then on the weekends, or whenever somebody's not paying attention to the customer, the flywheel is spinning, and basically the product is pushing customers to pay more money.
Got it.
Yeah,
okay.
That's the idea. And there are a whole bunch of consequences of that Kenny and I worked on a blog post about it and how it works. And I think in the next couple of years, we're going to see some really amazing businesses. I mean, Atlassian will probably be the first of these companies to go public. And Atlassian has been cash flow break even since I think almost the very beginning. And it's going to be a huge multi-billion-dollar company. And I think it's going to be a very sharp contrast to the high cash burning, super fast growing SaaS companies that we've seen of late. Atlassian is going to be just a steady grower, but cash flow break even all the way through. And super capital efficient, right?
Yeah. It's interesting that kind of like sort of well-run business that's actually generating predictable growth and profitability, it seems like an innovation.
Yeah.
In the venture-backed world, you're used to looking for companies that grow really fast because you're assuming that the growth will eventually reach a point at which it's big enough, then you can start to make it throw off money, right?
Yeah, I mean, so there's this company called Concur. So my partner Jeff Brody invested in Concur. It's an expense management company. Actually started off as a floppy disk company.
Okay.
Initially, it sold expense management software on floppy disk, then CD-ROM, then it became a licensed software company, and then 3 years later, it became the first SaaS company. And that's an amazing transition for a business. And if you take a look at the history of the company, like right around when they went public, they were cash flow break even and growing 30%, right? And that's what a lot of software companies look like. And then after 2008, the cost of capital for startups just generally collapsed because of what the federal government was doing with TARP and all that stuff. It became much easier in order to raise capital at increasing valuations without that profitability. And so consequently, you've seen the growth rates of these companies go from like 30% a year to 100 plus a year. But at the same time,
because they're just pouring capital on
because it's cheap. Right? Yeah, they can grow faster, right? Because the cost of capital is less. You know, compare that with Concur that went public like a year, I think, before the crash. Cost of capital was through the roof. The growth rates change, but also the net income. The negative net income that they sustain in order to grow that fast is much larger. And so, you know, if there comes a time when the environment changes and goes back to something more like 2002, 2003, I think you're going to see kind of a reversion to slower growth rates, 30, 40, 50%, but a preference for profits sooner than today.
But those could potentially be the same companies. They just have to kind of pull the levers on how fast they're hiring and exactly how their sales structure is set up. And
it's exactly the same company. It's just a different management style. Right.
One of the things that started this series of discussion was my interest in platforms and kind of how platforms create more value than they capture, right? Because they're creating something that lots of people can use. And so WordPress, GitHub, Amazon Web Services, these are all things that sort of lots and lots of people use, and they turn into fantastic businesses. But they also generate a lot more additional value beyond that because people can build on top of them. Do you spend much time thinking about that, or because it's also a very abused marketing term?
Like all business terms, it kind of grows to encapsulate lots of different things because everyone wants to be a platform because, like you said, they generate huge amounts of value. We have been big investors in platforms as a service, right? So we were the first investors in Heroku, actually not the first institutional investors in Heroku. And that's grown to be an enormous business. And we're investors in Twilio, which is another platform. But
I talked to Jeff Lawson from Twilio in an earlier episode of this podcast. So
awesome. What a business he's built. It's amazing. I think lots of companies want to become a platform ultimately. It's often really difficult to start off saying, I'm going to be a platform. And a lot of times what ends up happening is a company succeeds by building one particular product that then they can pry open the market and become a platform, right? So Salesforce is a great example of this, right? Like Salesforce's architecture is an incredibly flexible database. And on top of that infrastructure, they built the first application, which was CRM. And then Adam Gross became the architect, the chief marketer for Force.com, which became the Salesforce platform. And then lots of other applications could kind of be plugged into the same flexible infrastructure. Right, and so you had a bunch of different successful applications, and now you have Veeva, right, which is a publicly traded, I think it's a $4 or $5 billion company that's pharmaceutical only, built on top of Salesforce, on top of that platform. That's an amazing evolution of a platform. I think the game plan is a brilliant one, and it's a great example of how you start off with a flexible platform out of the gate, which means you need a great architect. But you don't sell the platform initially, you sell a product or a point solution on top of that platform. You get enough usage and data, and you become so important to a bunch of different enterprises' business that then you can plug in a bunch of other stuff.
It sounds like almost like something that you can't set out to plan to do from the start.
It's really difficult to market yourself that way as a generic thing because customers don't buy generic objects. Like selling a database today is really tough. Like look at the way that Amazon Web Services is structured. Like I'm not selling the whole platform. You're not buying AWS. You're buying compute, you're buying storage, you're buying routing, right? Like, and so each of those point solutions, you start with S3 and EC2, those were the two first ones. And they weren't selling you AWS, they were selling you computation in the cloud and storage in the cloud.
That's
and
right.
then they were able to put in a bunch of other stuff. And then there's a marketplace of third-party vendors.
Yeah.
You can envision building a platform, but you can't market it as a platform out of the gate because people are not going to understand what you're talking about.
Got it. What's the role of open source in all this? Does it still play a role for
your
point of view?
There's a huge amount of innovation I think that's happening in open source. In enterprise, there are 3 layers to the stack that we look at. There's applications, which is SaaS, platforms, which we just talked about, and then there's infrastructure software, which is below all that stuff. And the big change that's happened in infrastructure software is most enterprise buyers prefer to buy open source. And that's a fundamental change. So as a consequence, all the monolithic old infrastructure vendors are now being torn apart by open source companies, right? So you can look at the MapReduce Hadoop evolution is kind of the first step of that in the file system, right? You're seeing lots of different open source database. Cassandra is a great example there, right? Which is commercialized by DataStax. And so people are really looking forward for open source. The interesting debate within open source is what is the best way to make money with open source software, right?
That's fairly well established by now, isn't it?
Not really. So you've got a bunch of different models, right? And we can talk about the licenses, but the software is totally free, and we're going to put some services around it. So that's Cloudera's initial model. It's Hortonworks' model.
Yeah, that goes way back.
Yeah. And Red Hat was a little bit like that in the beginning. Then you've got this notion of what's called like an open core model, which is we're going to give the engine away for free, but if you want management or more sophisticated software, that will remain closed source and we'll charge for that. So MapR is a really good example of that, where it's got an acceleration technology. And we work with a bunch of open core businesses. Zimbra, which was started by my partner Satish, was probably the first open core business. And now we're starting to see in startup a bunch of other models for commercializing open source. Open source is a terrific distribution strategy. It's a great way to get technical people to try your product. And the thing is, you need to architect your monetization strategy from the very beginning. Because if you give too much away in the open source, you may never be able to commercialize in a open core fashion.
Right.
Yeah.
And it works so well in infrastructure because...
Well, because the buyers are super sophisticated. An IT ops manager is not going to want to talk to a relatively unsophisticated salesperson, right? They're going to say, show me the technology.
Yeah, or just let me have it and I'll play with it and I'll figure it out.
Yeah. And then the other thing is, there's an aversion to being locked into a particular ecosystem, right? So like the Oracle ecosystem or the IBM ecosystem, like if you were an Oracle shop, it's much easier just to buy a whole stack Oracle, which gives you no negotiating leverage when it comes to renewal time. So now, modern day IT buyers, they really want a system where they can say, I can switch, or I can understand what the switching costs would be. And that's why open source matters.
Okay.
Yeah.
I want to ask one last question, which is sort of what areas are you really excited about right now?
Yeah, I'm spending a lot of time in speech recognition. So I've written a little bit about this. I saw the movie Her.
That's a great movie.
It's a great movie. Set aside the whole romantic relationship with the computer for a second, which was, Spike Jonze, I think, was the director. I think his vision of the way that we're going to interact with computers is right around the corner.
Talking to them, you mean?
Yeah, like the main character just talks to a computer and he composes a letter, right? Because that's his job. And then he steps in the elevator, he puts in a Bluetooth headset and he says, play a melancholy song. And he doesn't like that song, so he says, play me another melancholy song. And then he says, read me my email, and he just responds to his email. Speech recognition accuracy has improved 50% in the last 2 years as a consequence of deep learning. And so I think there are going to be lots and lots of different applications, both in consumer, but also in the enterprise of far more sophisticated and far more accurate speech recognition technologies. So I'm really excited about that space.
Cool. There's another thing about that movie, which is because everyone's using speech recognition, there's a subway scene or something like that. People are walking around in the city where instead of staring at their screens like we do today, they're all kind of mumbling to themselves.
Yeah, I know. I know, all together and all separate at the same time.
So I'm sure we'll find different ways to obsess about our technologies no matter what the interface is.
Yeah, exactly.
Cool. Well, it's been really a pleasure to talk with you, so thank you for taking the time.
Oh, thank you for having me. It's been a pleasure.
All right.
Thank you, Dylan.
You've been listening to What to Think, VentureBeat's technology news podcast. As always, you can find us online at VentureBeat.com. And if you have not done so yet, please subscribe to us. Just search for What to Think in the iTunes Music Store or on SoundCloud, and you'll find us there. Ruth, thanks for joining me on this week's podcast.
Thanks so much for having me.
We'll catch you guys next time.